As investors realized these loans were not performing, they were now willing to pay only $95 million for the same batch of loans, and in some cases even less. In addition, as many of these investors used the loans as leverage for other investments, they were used on margin, similar to what you might do on an investment account. As the value of the funds was decreasing, the mortgage companies were also forced to pay into the investment to make their margin calls, forcing additional pressure and cash drains. In a sense, this was the perfect storm for mortgage companies, and they are paying for it with their company's life. This was seen with the recent demise of American Home Mortgage and other companies, as investors decided they didn't want these loans, forcing the companies out. What happened next is we saw the slowdown in the real estate market as home prices started to deteriorate in 2006. However, we've never seen a real estate market on a national scale where home prices fell. The investment and underwriting guidelines for which these loans were originated were in part based on this. As home prices started to stagnate, many people who obtained loans based on the premise of continually escalating home prices were caught in a trap. As they were unable to sell and unable to refinance their loan, the homeowner who had been living a lifestyle based on their equity was now maxed out, having spent away beyond their normal means. With no more equity to pull out to consolidate or lower their payments, they were now in trouble. As a result of these problems, we now have loans in the investment markets where even if a lender were willing to approve them, they wouldn't be able to sell them, effectively turning them into officer and a gentleman loan, screaming, "I got nowhere else to go." So what's next for real estate? Well, let's think about this. With changes to credit tightening, a huge number of people will now be unable to purchase a home. On a percentage basis, we're talking about a minimum of 15% of borrowers will be impacted by processing styles and loan availability alone. In a U.S. market where 6 million people buy homes, you just took 900,000 buyers off the market. And it doesn't mean that people won't still need to sell, though. Consequently, we're seeing increasing inventories and increasing marketing times. I don't think that 12 months of inventory is an unreasonable estimate, as many areas of the country are already experiencing well in excess of 18 to 24 months. Accompanying this will be more foreclosures. Foreclosure activity in July was double what it was for the same time last year. It's estimated that in the next 12 to 18 months, over 2 million people will be faced with their adjustable rate mortgages resetting, resulting in an increase in their minimum payments of anywhere from 30 to 100%. While this one action will not push people over the top, what it does do is add additional strain to an already over-leveraged consumer. Add in any life event, such as injury, loss of job, or increasing payments due to rising interest rates in the consumer arena, and you have a recipe for financial disaster. Now, if I'm a seller, I need to be aware of this in light of a slowing housing market. For anyone who has seen rapidly appreciating property values the past few years, it can be difficult to accept the fact that their home is now worth less than before. However, to use a stock market analogy, if you need to sell stock that yesterday warranted $10,000 and today was worth $8,500, would you decide not to sell, even if you were now losing money? Of course not, provided you had the means to absorb the loss. Well, the same beliefs should apply here. The borrowers who will be caught up in the mess are the ones who are looking to obtain minimal to no documentation type loans. This includes those with great, good, and poor credit alike. Some have estimated that these types of loans account for nearly 40 to 70% of all the loans originated in 2005 and 2006, What this means for real estate moving forward is that there will be far fewer buyers who are able to qualify under the terms of their last mortgage. While this won't necessarily take all these people off the market, obtaining financing going forward will be a much more difficult process for them. But not everyone is caught up in this mess. For the plain vanilla type of borrower, someone who has a job, savings, and the ability to provide documentation as used to be required, these borrowers are still fine. And with some products, there will be some stated income opportunities without exorbitant rates. Now, in addition, government loans will pick up a lot of the slack for those individuals with credit issues and minimal down payments. However, as this situation continues to evolve, things are subject to change, so it's important not to get too comfortable. So let me ask you a question. What would you do, or what would your business look like if you were to close 50% fewer deals over the next 12 months? Now, all of the factors mentioned here so far could very well have that kind of impact on many in our business. However, it doesn't have to be this way. There are opportunities for everyone in our business. There are opportunities with sellers and with buyers, but we have to act fast, act decisively, and get started now. For sellers, it's important that they get real about their pricing quickly. They cannot afford to wait, as pressures will build rapidly, and when they do, money will be lost. The lowest price that they may be willing to accept today could be very well become an unrealistic wish 6 to 12 months from now. And if they don't reduce their price, their home may never even get shown. Also, as lenders have now pulled back on second mortgages, sellers may need to consider holding a second in some cases.